Thanks so much for joining again. I thought I'd do a very quick introduction on credit risk. When I look at credit risk and I want to learn more, I usually look at 4 areas. The first area, which I'm covering today, is give you a definition about what credit risk is all about. Secondly, and I do another video on this area, is to understand credit rating agencies and credit ratings. The most important and well-known credit agencies, Moody's, Standard & Poor's and Fitch. So it's important to know how they rank, how they rate companies and issuers. Then number 3, and I do other videos as well, is to understand how to analyze credit risk. There are the 5 C's of credit risk analysis, to understand sources of risk and how to measure risk. And then the last one is all about factors impacting yield spreads. What is yield? Yield spreads reflects basically the compensation or the premium that investors demand for taking on risks beyond those of a risk-free bond, particularly talking about credit risk, which is the risk that the bond issuer might default. So there are a few factors driving those yield spreads: macroeconomic factors, market factors, and company-specific factors. So these are usually the 4 areas you should look into if you want to understand more about credit risk. There are a few formulas when we look at measuring risk and credit risk analysis. Also, it's a bit different when you look at a corporation, company versus government. But in general, credit risk is the same. So what is credit risk all about? Credit risk is the risk of economic loss resulting from borrower failure to make full and timely payments of interest and principal. Usually the mathematical formula for credit risk is the probability of default. How likely is it that the borrower cannot make interest and principal payment, and the loss given default happen. So if there's an 80% chance that the borrower becomes default, then once the borrower becomes default, how severe is the loss? So that's usually the formula. I will explain more in another video. What does it mean, borrower and interest and principal? So think about a company, one needs money and decides to raise debt. Because credit risk, we are concerned with debt payments. That's why we call it interest and principal. So if the company wants to raise 100, then the investor pays $100 to the company. And then over the lifetime, maybe they have an agreement for 5 years. Over the lifetime, when we talk about bonds many times, at the very end of the 5 years, the company pays back the principal, and throughout the 5 years, the investor wants to have a return. Otherwise, why should the investor provide capital to the company? The company also pays interest. And interest on bonds or debt instruments are called coupon payments. This is basically the compensation for the investor that you provide capital to the company. Another example, if it's you and you go to the bank and you need money for a house and you ask for 100,000, won't be a house, not even a small one, potentially, depending on where you live. Then you ask for a mortgage from the bank, you pay back the principal, and you need to pay some interest as well. Principal, usually you pay every month. You pay down the 100,000 at the end of the lifetime. The 100,000 are paid back, and then the interest is what you pay as a kind of fee to the bank. And credit risk, what does it mean? Credit risk is resulting from borrower failure. So results the company is not able to pay 100 or interest. Or it means if you as a person become default, you are not able to pay principal or interest. Yeah, so when we talk about credit risk, it's all about understanding and analyzing how likely is it that here in this case a company, here in this case you as a person, are unable to make those payments, because then you are default, you have a contract in place. And then once you become default, how severe is the loss? Yeah, and there are different tools, different frameworks, different things to look at, which I will cover in another video. Thanks so much for listening. Talk to you later.